the economy is still pretty healthy. We can debate where it goes from here, but the GDP keeps on ticking. You've got effectively no new supply growth. I mean, construction starts on a 2-year comp are down like 82% in the United States. And so, the forward pipeline of supply looks very different than the last 3 years. You've still got good fundamentals going on underneath that surface. Absorption of multifamily in the Sunbelt has set records 4 quarters in a row for the number of absorbed units. And so the demand is still there. If you think about seniors, which we referenced, the aging demography of America, the inability to continue to defer care, it's a very real and present, demographic problem that's driving demand in that sector. But the supply response is not quite there. And most new supply doesn't really pencil right now. Rates are below construction feasible rents, with higher borrowing cost, higher development cost, higher capitalized development cost. It takes a lot more what you have to believe to make that development work. So there's a bit of a laggard in the supply response. I mean, go back to real estate in the 1970s, and yes, it was primarily office buildings, but how many office buildings got built in the 1970s? Not many. The development of real estate office boom was in the mid 1980s when money got free again. And so you had this sort of benign period of very limited supply, but underlying demand growth that persisted. And so from 74 to 82, income growth in real estate was pretty significant. And, you didn't need a revaluation of the assets. You didn't need cap rate compression to drive growth. You just took income growth. And I think we're starting to see that. We reference seniors. I think the consensus expectation for 26 NOI growth in seniors is now somewhere between 7 and 10%. That's an enormous number. Context of leveraged real estate. I think multifamily rents next year will be up more than 2 to 3%, in most markets. And so, to me, that creates the opportunity for real growth, the ability to go access those income streams at today's reset pricing levels. But then, enjoy a period of benign supply and decent fundamentals where you can push NOI, that's pretty darn good investing. And so I do think that inflation hedge is about to kick in. And I think you're about to see NOI growth that's, well above average. And, that's sort of the hope and the good news for the industry is that, so long as the economy stays healthy, we can grow our way out of this and recover a lot of value and create a lot of value in the years to come.
Is there any real estate that does well, even if the economy starts to, we go into a recession?
Honestly, I haven't found it yet. I don't think anyone's immune is the problem. There's theory about why, and, multifamily in theory should be okay because we all have to have a place to live, but people trade down, that's a very real phenomenon. And so, I think everybody feels it. And if anything, I think it's market psychology. Like, fundamentally what something's worth is what people think it's worth. And so when the economy takes a turn, fear can win out over greed and everybody can overcorrect, even if the fundamentals stay okay.
Right. So this glaring exception to what you're talking about right now within the real estate sector is data centers.
Yes.
Because they are being built, faster than we can imagine. And it's easy to understand the need for them, but it's hard to understand the long-term utility and what the capital cost will be to maintain them and who's going to buy them in the future. And the dollars are just so large. So how are you investing in the world's most important trend right now?
Carefully and with humility. I'd say data center is by far the most interesting question in real estate today. Hottest sector, most activity, and sort of least amount of known information. We've not lived this cycle before. We've not seen these assets for 30 years. And so there's just a lot of questions about them. And so I've got a few thoughts on data centers. I'd say first, the underlying thematic is pretty obvious and pretty irrefutable. Like technology is eating the world and AI is exceptionally powerful and it is coming and it will change nearly everything. And with that will doubtlessly come the demand for more computational power, more processing power, more storage.
I just have to stop you for 1 second because the minute you say it that way, I know you're making an analogy to software is eating the world, and we all know what's happening to software. So, what could go wrong with that statement?
That's pretty much the humility I'd say that sits behind this. Is these things change faster than we can imagine. They can change. And today's certainty is tomorrow's forgotten wisdom. And so, software is an interesting test case of that, right? AI is changing the way software works. And so, am I certain that nothing in my lifetime will change the way AI works? Of course, I'm not certain about that. And I think you have to embrace this with that uncertainty. But that thematic is pretty real. The data center demand, I think, is pretty real. I think the challenge is that on the journey to manifest destiny, in the way toward inevitable technological evolution, market cycles and the price of risk and income can dislocate from that underlying driver in pretty material ways. I've taken to using an analogy that, is exceptionally dated, and I surely didn't live through it. But, I think the analog to data centers and AI in particular is sort of the railroad revolution of the late 19th century in the United States. It was a technology that changed everything. It changed the shape of the world. It changed geopolitics. It changed the distance of the world. It changed every industry in America. It was a fundamental unlock of technology that unlocked productivity, the likes of which we had never imagined before. And for 25 years, there was a capital cycle of investing in railroads and the technology of railroads that was unstoppable. It was enormous. But in those 25 years, you also had two massive financial panics, and you had huge stock market crashes, because speculation and development can be different things. And, that's what I try to take as humility into this conversation, is recognizing that how we price an asset and whether we need that asset may not always be perfectly correlated.